When a grocery store has empty shelves, that is a shortage. But when that same store refuses to buy truckloads of fresh produce standing at its door, something is fundamentally broken. January 22nd, 2026, silver hits $95 per ounce. Demand up 400%, Shanghai paying over $100. Yet America's largest wholesale distributors, the pipelines between the U.S. Mint and your local dealer, are posting 2 words on their buy sheets: no bid. They won't buy your silver. Not at $95, not at any price, not because they don't want it, but because they cannot pay for it. The credit lines are frozen. And when the distribution system loses access to capital, markets don't just slow down, they stop functioning entirely. Welcome to Silver Radar. You know, in times like these, when the financial architecture itself begins showing cracks, it's not the young traders who see it first. It's those of you who've watched markets long enough, who remember when credit meant something, when handshakes backed by bank lines actually held. If this analysis resonates with your experience, if you've seen this movie before in '80 or '08, do us the courtesy of hitting that subscribe button. We're building a community of serious minds here, not speculators, strategists. And tell us in the comments, where are you watching from today? Are you in the States watching this unfold in your backyard? Or observing from abroad as the world's largest precious metals market seizes up? Your perspective matters here. Now, let's understand exactly what broke and why it matters far beyond silver. There exists a fundamental law in economics, so basic that even a child selling lemonade understands it instinctively. If you have something people want, someone will buy it. If people need something you have, they will pay you for it. This is not theory. This is the foundation upon which every market, every exchange, every commercial transaction in human history has been built. But on January 22nd, 2026, that law stopped working in the United States precious metals market. The evidence arrived not through dramatic headlines or government announcements, but through a simple trade sheet, the kind of document that circulates every morning among wholesale bullion dealers. These trade sheets are unremarkable. Rows and columns listing what dealers will sell and what they will buy, the prices they offer, the premiums they charge. Boring paperwork that keeps the machinery of commerce turning. Except this particular trade sheet, from one of the largest authorized purchasers in the United States, told a story that should be economically impossible. On the sell side, where these wholesalers list their available inventory, every line read the same. American Silver Eagles, sold out. Canadian Maple Leafs, sold out. 100-ounce silver bars, sold out. 1,000-ounce institutional bars, sold out. This part made sense. The physical silver shortage has been documented, analyzed, predicted by those paying attention to the Shanghai Premium and COMEX inventory drawdowns. Supply crisis? Understood. But it was the buy side, the column where wholesalers list what they will pay you for your metal, that revealed something far more disturbing than a simple shortage. Product after product, listed as no bid, not low bid, not reduced bid, but no bid at all. Let that sink in for a moment. These are companies whose entire business model depends on buying and selling precious metals. The authorized purchasers who sit between the United States Mint and your local coin shop, the essential pipelines of the physical market, and they are refusing to purchase silver trading at $95 per ounce, a price that shattered the previous all-time high. Silver with retail demand up 400% according to preliminary industry data. Silver commanding over $100 per ounce in Shanghai, creating a premium that signals desperate Eastern buying. Silver that Samsung needs for photovoltaic cells, that Tesla requires for electrical contacts, that industrial users cannot substitute away from. By every known law of supply and demand, these wholesalers should be aggressively bidding for inventory. They should be offering $95, $96, $97 per ounce. Just to secure metal they can immediately flip to desperate buyers. They should be working phones, sending trucks, doing whatever it takes to acquire the most sought-after commodity on the planet. Instead, silence, no bid. The grocery store analogy becomes precise here. Imagine walking into a store and seeing empty shelves. You understand immediately. There is a shortage, supply chain disruption, high demand. Now imagine pulling up to that same store with a truck full of fresh produce, walking inside, and having the manager look at you and say, "I have nothing to sell, but I also refuse to buy what you're offering." You would immediately know something is broken in the fundamental operating system of that business. This is not a supply problem anymore. This is not a demand problem. This is a functionality problem. The authorized purchasers, the wholesalers who move millions of ounces monthly, are not refusing to buy silver because they don't want it. They are refusing because they cannot pay for it. These companies are not insolvent in the traditional sense. They technically own silver, they have assets on paper, contracts showing metal they've purchased. But they have run out of something more immediately critical than assets. They have run out of cash. More specifically, they have run out of access to the credit lines that allow them to operate. A precious metals wholesaler is a volume business, operating on margins measured in pennies per ounce, moving metal by the ton, by the truckload, by the container ship. They do not buy a bar of silver with cash from their checking account, wait for it to sell, then buy another bar. They borrow millions, purchase bulk inventory, hedge their price exposure in futures markets, ship the metal, collect payment, repay the loan, and immediately do it again. The entire system runs on credit velocity, and when that credit disappears, the whole machine stops. Not gradually, not with warning signs and adjustment periods, instantly. Like an engine that runs out of oil, seizes, and refuses to turn over no matter how valuable the cargo it was hauling. The trade sheet with no bid, listed across multiple products, is not showing a business decision. It is showing a system failure. And the question that should concern every person watching the financial markets is devastatingly simple. What breaks the credit system that funds the pipelines of the world's largest precious metals market? Most people believe they understand how the silver market works. They picture it simply. Mines extract metal from the ground. Refiners process it into bars and coins. Dealers sell it to the public. A straightforward supply chain, like any other commodity. This understanding is not wrong. It is just catastrophically incomplete. Because between the refiner and the retail customer, between the mint pressing coins and the shop selling them, exists an invisible architecture that most market participants never see. An architecture built entirely on borrowed money. The authorized purchasers, the wholesale distributors now posting no bid on their trade sheets, operate in a financial dimension that has almost nothing to do with physical metal. They live in the world of credit instruments, hedging positions, and counterparty relationships. Understanding their sudden paralysis requires understanding what they actually do, and more importantly, how they pay for it. Consider a typical transaction cycle. A wholesaler receives an order from a network of coin dealers, let's say 50,000 American silver eagles, needed within 2 weeks to meet retail demand. The wholesaler does not have 50,000 eagles sitting in a vault. They do not have $4.75 million in cash, sitting in a bank account waiting to purchase them. What they have is a credit line. They call their banking partner, a major institution that specializes in commodity financing, and they draw against their revolving credit facility. The bank transfers $4.75 million to the wholesaler's account. The wholesaler immediately purchases 50,000 eagles from the U.S. Mint, or from another wholesaler with inventory, or from a refiner with allocated metal. But here is where most people's understanding breaks down completely. The moment that wholesaler owns 50,000 ounces of physical silver, they are exposed to catastrophic risk. Silver is trading at $95 today, but what if it drops to $90 tomorrow, to $85 next week? They borrowed $4.75 million to buy metal they cannot sell for another 2 weeks when their dealer network takes delivery. If the price falls, they are holding inventory purchased with borrowed money that is now worth less than what they owe. So within minutes, sometimes within seconds of purchasing physical metal, they hedge. They sell short an equivalent amount of silver futures contracts on COMEX, locking in their selling price, eliminating their price risk. Now they are market neutral. They own physical silver. They are short paper silver. Price movements no longer affect their position. They make their profit not from price appreciation, but from the spread, the few dollars per ounce difference between what they paid and what dealers will pay them. 2 weeks later, dealers take delivery, pay $485 million for the 50,000 eagles. The wholesaler closes their short futures position, repays the bank's credit line plus a small amount of interest, and nets perhaps $75,000 profit on a $4.75 million transaction, a 1.5% margin. Razor thin. This is why they need volume, why they move millions of ounces, why the entire business model depends on velocity. Buy, hedge, ship, collect, repay, repeat. 20 times per month, 200 times per year. Each cycle generating a small profit that accumulates into a viable business. But notice what makes this machine work. Not the metal, not the demand, not even the price. Credit availability. The wholesaler's ability to borrow millions on demand, multiple times per month, with minimal friction and predictable terms. Their banking partner must be willing to extend that credit line. Confident in the collateral, comfortable with the counterparty risk, and operating within their own regulatory constraints. Now consider what happens when a bank's risk management committee meets on the morning of January 22nd, 2026. Silver has broken its all-time high. Volatility has exploded. The Shanghai premium has widened to $10 per ounce. COMEX inventories are at historic lows. The head of commodity lending reviews the bank's exposure to precious metals dealers. Total credit lines extended, $850 million across 12 major wholesalers. Current utilization, 87%. That means these dealers have borrowed $739 million, backed by silver inventory and futures hedges, in a market that is now exhibiting severe stress signals. The risk officer asks a simple question. If 3 of these dealers cannot meet margin calls on their hedge positions, what is our exposure? The answer, uncomfortable. If we have to liquidate their collateral in a disorderly market, potentially $200 million, another question follows. What is our regulatory capital requirement if we classify these loans as higher risk? The answer, more uncomfortable. We would need to hold an additional $45 million in reserve capital, reducing our ability to lend elsewhere. The decision matrix becomes clear. The bank is not losing money on these credit lines. The dealers are paying interest and have been reliable counterparties for years. But the risk-adjusted return has shifted dramatically. The potential downside now outweighs the modest interest income. And here is the critical mechanism that most market observers miss entirely. The bank does not announce this decision publicly. They do not issue a press release stating they are reducing commodity dealer exposure. They simply stop approving credit line increases. They delay responses to rollover requests. They add additional collateral requirements that dealers cannot meet. They quietly, systematically withdraw liquidity from the system. And because wholesale dealers operate on such thin margins with such high leverage, even a 20% reduction in available credit is catastrophic. A dealer who could previously borrow $50 million can now only access $40 million. They must choose. Do they fulfill existing obligations and refuse new orders, or do they default on commitments already made? Most choose the former. They honor their current contracts, ship the metal they've already purchased and hedged. But they stop buying new inventory entirely, because without the credit line to fund purchases, without the ability to borrow and hedge and ship, they literally cannot operate. The trade sheet that morning, the one showing no bid across multiple products, was not showing a lack of desire to buy silver. It was showing the exact moment when credit access fell below the threshold required to function. And when multiple dealers hit that threshold simultaneously, the market does not slow down, it freezes. There's a moment in every structural collapse, whether it is a building, a bridge, or a financial system, when observers ask the same question. What was the exact moment it failed? And the answer is always more complex than people want to believe, because structures do not fail at a single point in time. They fail across a sequence of fractures, each one weakening the integrity of the whole, each one creating stress that transfers to the next vulnerable point. Until finally, one last fracture exceeds the system's ability to compensate, and everything comes down at once. The precious metals credit freeze of January 2026 did not begin on January 22nd. It began weeks earlier, with fractures so small that most market participants dismissed them as noise. The first fracture appeared in Shanghai. December 2024. The premium for physical silver in Chinese markets began separating from Western spot prices. Initially, 50 cents per ounce, then $1, then $2. Market analysts explained this as temporary friction, arbitrage opportunities that sophisticated traders would quickly eliminate. Except the premium did not narrow, it widened. By early January 2026, Shanghai silver was trading at $7 over London spot, then $9, then by the third week, over $10 per ounce premium. This was not friction. This was a one-way drain, physical metal flowing east with no corresponding flow west. The Shanghai Gold Exchange, the world's largest physical precious metals market, was absorbing every available ounce and demanding more. Western wholesalers watched this with growing concern, because that premium represented something dangerous. It meant that anyone holding physical silver in the United States could theoretically ship it to Shanghai and capture an instant 10 profit per ounce. It meant that every industrial user, every dealer, every investor with allocations was looking at their inventory and calculating whether to break contracts and chase that premium. The second fracture appeared in COMEX warehouse stocks, the futures exchange where wholesalers hedge their positions, where paper silver theoretically represents claims on physical metal, began bleeding registered inventory, not slowly, dramatically. In the first 3 weeks of January, over 47 million ounces withdrawn from registered vaults. These were not normal inventory fluctuations. These were institutional holders, banks, and authorized participants pulling physical metal out of the exchange system entirely. Why? Because the widening Shanghai premium was a signal they could not ignore. Physical metal was becoming more valuable outside the exchange than inside it. The paper market was losing its gravitational pull on the physical market. And when that happens, when futures prices no longer converge reliably with spot prices, The entire hedging mechanism breaks down. Remember, wholesalers depend on that hedge. They buy physical, sell paper, and assume the two prices will move together. But if physical is worth $100 in Shanghai while paper is trading at $95 in New York, the hedge fails. The risk protection disappears. And suddenly, every physical purchase becomes a naked bet on price direction instead of a hedged arbitrage. The third fracture appeared in delivery obligations. By mid-January, whispers began circulating through the wholesale community. Delivery delays, not of days, of weeks. Orders placed in December for January delivery pushed to February. February orders pushed to March. Refiners and mints citing production constraints and unprecedented demand. But production constraints do not explain why products listed as in stock on Monday become 6 to 8 weeks delivery on Friday. That is not a production issue. That is an allocation crisis. Someone, somewhere in the supply chain, was making decisions about who gets metal and who waits. And those decisions were not based on order sequence or customer relationships. They were based on credit relationships. The customers with the strongest banking connections, the largest credit lines, the most institutional backing, were getting their deliveries. Everyone else was being told to wait. The fourth fracture appeared in the futures market itself. January 20th, open interest in March, silver contracts stood at levels that represented potential delivery obligations of over 180 million ounces. COMEX registered stocks, barely 40 million ounces. This mismatch is not unusual. Futures markets typically operate with far more paper claims than physical backing, because historically, most contracts settle in cash, not metal. Traders take profits or losses financially and roll their positions forward. But in January 2026, something changed. The percentage of contracts standing for delivery, contracts where holders demanded physical metal instead of cash settlement, began rising. First it was 3%, then 5%, then by the third week, over 8% of open interest was indicating delivery intention. That might sound small, but 8% of 180 million ounces is 14.4 million ounces, and the exchange only had 40 million ounces registered to satisfy all potential deliveries. Suddenly, the banks and institutions that had sold those futures contracts as hedges, the very contracts that wholesalers depended on, were facing a nightmare scenario. They might actually have to deliver physical metal they did not possess. And where do you find 14 million ounces of silver in a market where Shanghai is paying $100 and wholesalers are posting no bid? You don't. This is when the banking risk committees convened. Not publicly, not with announcements, but in conference rooms where exposure reports were presented and decisions were made. The calculus was brutal. If we maintain current credit lines to precious metals, wholesalers, and the delivery squeeze intensifies, we could be funding purchases of physical metal that our own trading desks cannot deliver against short futures positions. We would be financing our own counterparty failure. The risk management solution was obvious: reduce exposure immediately. Cut credit lines before the delivery crisis forces liquidation at distressed prices. Protect the institution's capital before the system implodes. And so, between January 19th and January 22nd, multiple banks implemented the same decision simultaneously. Not through coordination, but through identical risk assessment reaching identical conclusions. Credit line reductions. 15% here, 25% there, 30% at the most exposed institutions. The wholesalers, who had been operating at 85 to 90% credit utilization, suddenly found themselves over their new limits. They had to choose: liquidate existing inventory to reduce borrowings, or stop buying new inventory entirely. Most chose the latter. Because liquidating inventory in a rising market means capturing profits, but losing operational capacity. Better to fulfill existing orders, ship the metal already hedged and purchased, and simply stop taking new orders, stop bidding on new inventory. Go no bid until credit conditions normalize. Except credit conditions were not normalizing. They were deteriorating further, as other banks saw the first movers reducing exposure and concluded they should do the same. A cascade, not of failures, but of risk reduction decisions that collectively produced system failure. By the morning of January 22nd, when that trade sheet circulated showing no bid across multiple products, it was not showing one company's decision. It was showing the culmination of 4 weeks of fractures that had finally exceeded the system's ability to function. The Shanghai drain, the COMEX inventory collapse, the delivery crisis, and the banking credit withdrawal, 4 fractures, each one creating stress that transferred to the next point of vulnerability, until the entire distribution architecture of the American precious metals market simply stopped working. When a market stops functioning, the consequences do not remain contained within that market. They radiate outward, through interconnected systems, through dependent industries, through the psychological architecture of confidence itself. What happened on January 22nd, 2026 was not a price event. Price events are normal, silver rising to $95, breaking its all-time high. These are dramatic but comprehensible within traditional market analysis. What happened was a structure event, and structure events, when critical infrastructure fails to perform its designated function, carry implications that extend far beyond the immediate participants. The most immediate effect is the complete breakdown of price discovery. Price discovery, the process by which markets determine the true value of an asset through the interaction of buyers and sellers, requires functioning bid and ask mechanisms. When wholesale distributors post no bid, they remove one entire side of that equation. There is no longer a market price for physical silver in the United States. There is only an asking price. Dealers can tell you what they want to sell silver for, but without competing bids, that number becomes arbitrary. This creates what economists call a two-tier market structure. Paper silver, the futures contracts and exchange-traded funds, continues trading with apparent liquidity and discoverable prices. Physical silver, the actual metal, trades in a parallel universe where prices are determined by relationship, urgency, and credit access rather than open market forces. This divergence is not theoretical. By January 22nd, the premium on physical American silver eagles over spot price had reached $18 per ounce at retail dealers, not the typical $3 to $5 premium, but $18, meaning if paper silver was trading at $95 on COMEX, a physical eagle was selling for $100 and $113 at coin shops. A 19% premium. That gap represents the market screaming that paper and physical are no longer the same asset. For retail coin dealers, the ones who depend on wholesalers for inventory, this creates an existential crisis. Their business model assumes they can call their distributor, place an order, receive metal within days, and sell it to customers with predictable margins. When wholesalers go no bid and stop accepting orders, that entire model collapses. Dealers are left with whatever inventory they physically possess, unable to replenish, watching premiums rise while being unable to capitalize because they cannot source additional product. Some will survive by rationing existing inventory and raising premiums to slow demand. Others, particularly smaller dealers with thin capital reserves, will simply close. Not because people do not want silver, but because the distribution system that connects them to supply has been severed. But the implications extend far beyond coin collectors and retail investors. Industrial users of silver, the manufacturers who depend on steady supply for production, face a different but equally severe problem. Samsung needs silver for photovoltaic cells and solar panels. Tesla needs silver for electrical contacts and vehicle systems. Medical device manufacturers need silver for antimicrobial applications. These companies do not buy silver from retail dealers. They source through industrial supply contracts with refiners and specialized distributors. But those distributors are subject to the same credit constraints as precious metals wholesalers. When credit lines contract, industrial allocations become unreliable. Production schedules that assumed steady metal delivery now face uncertainty. Companies must choose between building larger inventories, tying up working capital in commodity storage, or accepting supply chain risk that could halt production. This is how a precious metals credit freeze begins affecting the real economy. Not immediately, not dramatically, but through gradual degradation of manufacturing reliability and increase in production costs. Yet perhaps the most significant implication is what this credit freeze signals about the broader financial system. Commodity dealer financing is not a large segment of bank lending. It represents a tiny fraction of total credit extended by major institutions. But it is a highly sensitive indicator. Banks that finance commodity dealers are sophisticated. They understand collateral. They have decades of experience managing these relationships. When these banks simultaneously reduce exposure to a sector, it indicates a shift in institutional risk appetite that likely extends beyond precious metals. If credit is contracting for commodity dealers, where else is it contracting? Are banks also reducing lines to other leveraged intermediaries? Are they pulling back from trade finance, from inventory lending, from the revolving credit facilities that keep distribution networks functioning across multiple industries? The precious metals market may simply be the canary, the most sensitive system showing stress first, while similar pressure builds in less visible sectors. This is the pattern seen in 2008. The credit crisis did not announce itself through mainstream banking channels initially. It appeared, first in specialized lending. In niche markets where leverage was highest and margins thinnest, mortgage brokers could not fund new loans. Commercial paper markets froze, money market funds broke the dollar. Only later, after these peripheral systems failed, did the crisis reach the core banking sector. The question facing strategic decision makers in January 2026 is whether this precious metals credit freeze is an isolated event, or an early indicator of broader liquidity contraction? And the evidence suggests the latter. Because the mechanics that broke the bullion market, rising volatility triggering risk reduction, Basel III capital requirements, limiting commodity exposure, banks prioritizing regulatory compliance over client relationships. These mechanics apply across the financial system. They are not specific to silver. For business leaders and institutional planners, this creates a strategic imperative. Evaluate credit dependency across your operations. If your business model assumes reliable access to revolving credit, to inventory financing, to trade credit from suppliers, test those assumptions now. Contact your banking partners, understand their risk appetite, confirm your credit lines are stable and not subject to sudden reduction. Build larger cash reserves to buffer against potential credit contraction. Diversify banking relationships to avoid concentration risk with a single institution. These are not panic measures. They are prudent responses to clear warning signals. For investors, the implications are equally significant. The divergence between paper and physical silver prices reveals a fundamental truth. In times of system stress, ownership claims and physical possession are not equivalent. A futures contract promising silver delivery and a bar of silver in your possession are legally different instruments. And when distribution systems fail, when credit markets freeze, the difference becomes material. This does not mean paper markets are fraudulent or that futures contracts have no value. It means that in crisis conditions, the ability to take physical delivery becomes constrained by factors beyond price. Credit access, relationship priority, institutional backing, these determine who gets metal and who receives cash settlement or delayed delivery. The strategic question is not whether to own silver, it is whether your form of ownership is resilient to system stress. The final implication, perhaps the most important for the business community, is understanding that markets are not natural forces. They are human constructs, dependent on infrastructure, credit, institutional relationships, and confidence. When any of these elements fails, the market does not continue functioning at a different price level. It stops functioning entirely. The trade sheet from January 22nd, showing no buy, showing no bid, is a document that should concern anyone who assumes markets will always be there to buy what you're selling or sell what you need to buy. Because it demonstrates with brutal clarity that when credit disappears, markets disappear with it, not gradually, not with warning, instantly. And the question every strategic planner should be asking themselves is simple. Which market do you depend on? That operates on the same thin margins, the same high leverage, the same credit-dependent model as precious metals wholesalers? And what happens to your business, your supply chain, your operations, when that market posts no bid? For investors, the implications are equally significant. The divergence between paper and physical silver prices reveals a fundamental truth. In times of system stress, ownership claims and physical possession are not equivalent. A futures contract promising silver delivery and a bar of silver in your possession are legally different instruments. And when distribution systems fail, when credit markets freeze, the difference becomes material. This does not mean paper markets are fraudulent or that futures contracts have no value. It means that in crisis conditions, the ability to take physical delivery becomes constrained by factors beyond price. Credit access, relationship priority, institutional backing. These determine who gets metal and who receives cash settlement or delayed delivery. The strategic question is not whether to own silver, it is whether your form of ownership is resilient to system stress. The final implication, perhaps the most important for the business community, is understanding that markets are not natural forces. They are human constructs, dependent on infrastructure, credit, institutional relationships, and confidence. When any of these elements fails, the market does not continue functioning at a different price level. It stops functioning entirely. The trade sheet from January 22nd, showing no buy, showing no bid, is a document that should concern anyone who assumes markets will always be there to buy what you're selling or sell what you need to buy. Because it demonstrates with brutal clarity that when credit disappears, markets disappear with it, not gradually, not with warning, instantly. And the question every strategic planner should be asking themselves is simple. Which market do you depend on? That operates on the same thin margins, the same high leverage, the same credit-dependent model as precious metals wholesalers? And what happens to your business, your supply chain, your operations, when that market posts no bid,